Ladies and gentlemen, thank you for joining me. I want to open with a fundamental truth that should guide every investment decision. History and logic consistently triumph over fleeting emotion. Right now, the global financial system is engaged in one of the most perilous experiments of our time, a massive, debt-fueled monetary structure being stretched past its historical, logical, and economic breaking point. When you analyze this situation objectively, the conclusion is unavoidable. Owning real, non-debt-backed assets is no longer a matter of mere prudence. It is becoming an essential requirement for wealth preservation. The global debt tsunami, an inevitable systemic risk. We are standing at the precipice of a significant systemic risk, a debt cycle that has accelerated far beyond sustainable limits. This isn't just a threat to stock prices, it risks undermining the very foundations of our modern monetary system. From a dispassionate, mechanical viewpoint, the evidence is compelling. We are deeply entrenched in the late stages of a long-term debt cycle, and the risk has mutated from a theoretical possibility into a palpable reality. At the core of this risk is a simple imbalance. The expansion of credit has drastically outpaced the economy's capacity to service it. Easy credit has undoubtedly fueled asset bubbles and created an illusion of permanent prosperity. But this prosperity is built on a literal time bomb of borrowed principal and mounting interest. The productive output and corresponding income of the economy simply cannot keep up with the burden of accumulating obligations. Interest payments are rising aggressively, and they are beginning to crowd out critical areas like public investment, social services, and even genuine economic growth. This is the financial equivalent of a terminal blockage in the system's artery. As debt service costs escalate, governments face a difficult, almost impossible choice. They must either pursue harsh austerity, cutting spending, raising taxes, which is politically catastrophic, or find an alternative method to manage the debt. Historically, the path of least political resistance has been the same: monetary expansion or simply printing money. This is not a conspiracy, it is the most accessible lever for a sovereign debtor. Rather than endure an outright, politically devastating default, central banks often step in to monetize the debt. The immediate consequence is currency devaluation, which stealthily transfers wealth from creditors and savers to the debtors, often the government itself. The devaluation acts like a slow-motion default, eroding the real value of the money held by citizens and penalizing those who played by the rules and held fixed-income assets. The mechanism, borrowing, reaching the limit, and then monetizing, is the recurrent heart of this long-term debt cycle. We move from a disciplined, sound money phase to a credit-fueled boom, and finally to the tipping point. We are in that final phase, where financial stress builds, confidence in the currency wavers, and the central bank's intervention becomes a destructive force. The precarious reserve status and the devaluation choice. What makes our current moment uniquely precarious is that this crisis is centered not just in a single nation, but in the major reserve currencies, most notably the US dollar. Global debt denominated in these reserve currencies has ballooned. Should foreign investors lose confidence in the sovereign debt of reserve-issuing nations, demand for their bonds could collapse just as the supply needed to roll over existing obligations surges. The consequence is a spike in interest rates to attract buyers, but higher rates merely increase the debt servicing costs, feeding the very problem they are meant to solve. In that pivotal moment, policymakers face the ultimate choice. Allow interest rates to climb. This leads to defaults, painful restructuring, and a guaranteed economic depression. Intervene via money printing, monetization. This maintains the appearance of stability, but guarantees inflationary currency devaluation. History overwhelmingly confirms they choose the latter. Why? Because while money printing is corrosive over time, an outright default is immediate, messy, and politically fatal. But this decision has profound side effects. Inflation utterly demolishes savers' purchasing power and erodes the fundamental trust in the currency itself. When this devaluation accelerates, people inevitably begin a flight into hard money, tangible, real-value assets that exist outside the fiat system. This flight is a vote of no confidence in the entire financial regime. The illusion of wealth and the coming reckoning. The core tragedy of this debt cycle is the illusion of wealth it has created. For decades, asset prices, stocks, real estate, and even long-duration bonds have been primarily driven higher by the relentless expansion of credit and the suppression of interest rates. This is not organic, productive wealth creation. It is a monetary phenomenon. People feel rich because their debt-inflated assets are worth more in terms of rapidly devaluing currency units. However, the moment the cost of servicing the underlying debt becomes unbearable, that illusion shatters. The interest costs start to compound the problem, rather than being managed by easy money. The global economy is trapped in what I see as an interest rate trap. Central banks cannot raise rates enough to genuinely fight inflation because doing so would trigger sovereign debt defaults and collapse the asset bubble they spent decades inflating. Conversely, they cannot keep rates suppressed forever without triggering catastrophic currency devaluation and hyperinflationary forces. The current geopolitical fragmentation only compounds this dilemma. As global trade patterns shift and nations like China and Russia seek alternatives to the US dollar, the demand for dollar-denominated debt could fall structurally. This loss of external demand means that the reserve currency issuer will have to internalize more of its debt burden, forcing the central bank to print even more aggressively. The cost of maintaining global hegemony is being paid by the individual saver through inflation. My perspective, the silver strategy, a dual-engine asset. This macro-risk environment demands a tactical shift for every investor. It's no longer just about default risk. It's about currency risk, inflation risk, and systemic resilience. Holding pure cash or conventional debt assets may offer a false sense of security. This is where the unique nature of silver becomes strategically compelling. What makes silver stand out is its hybrid identity. It is a bridge between monetary history and industrial necessity, making it a powerful hedge against the system's increasing fragility. Engine 1. The monetary anchor and protection against debasement. For centuries, silver served as money. It carried value independent of any government promise or debt. Today, in a time of radical monetary instability, silver acts as a non-fiat anchor. It is a physical asset that resists the dilution inherent in unchecked credit expansion and money printing. When faith in paper currency or its digital equivalent falters, silver provides a genuine hedge, a way to preserve purchasing power outside the liability-driven system. The monetary appeal of silver is often overlooked because of its higher volatility compared to gold. However, in a scenario where the public rushes out of fiat currency, silver's smaller market size means it has a greater capacity for dramatic price movement than gold. It offers a more leveraged play on monetary distress. It offers a tangible claim on real wealth when financial promises are evaporating. Engine 2. The industrial future and structural demand. Unlike gold, which primarily sits in vaults, silver is a working metal. Its industrial applications are not ancillary, they are central and rapidly growing. Solar energy, silver paste is indispensable in photovoltaic panels, forming the conductive pathways. You cannot have high-efficiency solar without it. The global push for net zero emissions guarantees a long-term, structural demand for silver in this sector. Advanced electronics. In every modern technology, from semiconductors, 5G infrastructure, and printed circuit boards to electric vehicles, silver is the critical conductive material. Its superior electrical and thermal conductivity makes it irreplaceable in high-performance applications. Crucially, these industrial uses consume silver, locking it into the products. Once the silver is integrated into a solar panel or a circuit board, it is, for all practical purposes, removed from the available commodity supply for decades. This physical consumption dynamic fundamentally tightens the supply-demand balance in a way gold does not experience. Demand is not speculative, it is structural and sticky. The asymmetric opportunity in dual value. This dual role creates an asymmetric opportunity for silver. Upside potential. It benefits simultaneously from monetary fear like gold, and from structural industrial demand, unlike gold. As the world electrifies and adopts renewable energy, the industrial engine guarantees a high, sticky base demand. Downside protection. If the economy weakens, monetary demand can often pick up the slack, preventing the price collapse typical of pure industrial commodities. It is less susceptible to a single downturn event. Furthermore, a significant portion of silver is a byproduct of mining for other metals like copper or zinc. This makes its supply inelastic. Production doesn't respond quickly to higher silver prices. Surging structural industrial demand, combined with an inelastic supply and the potential for a rapid pickup in monetary demand during a crisis, points toward persistent market deficits. The supply side is constrained, but the demand side is accelerating on two fronts. Strategic risk management beyond traditional diversification. Diversification in the current environment must go beyond the traditional 60-40 stock-bond split, which has proven highly correlated during inflationary and debt crises. True risk management today requires diversifying away from credit risk and currency risk. An asymmetric opportunity in a real asset like silver means you are making a bet where the potential gain from a monetary collapse or an industrial boom is massive, while the downside is limited by the metal's underlying intrinsic value and industrial utility. You are essentially using the asset as a hedge against the failure of the central banking consensus. The psychological benefit of holding such an asset cannot be overstated. When the news headlines scream about financial instability, holding something tangible, a kilo of silver, provides composure and resilience. It allows the investor to focus on long-term objectives rather than succumbing to the panic of short-term noise. The political dimension and the path to deleveraging. It is critical to remember that debt crises are never purely economic, they are profoundly political. The rising burden of debt often translates directly into stagnant living standards and widening inequality, which fuels populism and political instability. Leaders are caught between three unpopular choices. Austerity, politically suicidal. Redistribution, taxation, divisive and harms capital formation. Monetization, inflation, the hidden tax, the path of least resistance, but it destroys the long-term confidence required for a sound economy. The so-called beautiful deleveraging, a scenario of managed inflation, fiscal prudence, and structural reform to restore growth, is theoretically possible but historically improbable. It requires a level of global coordination, political discipline, and long-term vision that is increasingly absent in the fragmented world we inhabit. The most likely path remains the debt-death spiral. Rising interest rates force more money printing, which accelerates currency devaluation, which drives investors further into hard assets, which raises rates again, and the cycle continues until the currency collapses or a painful default and restructuring event occurs. Conclusion: preparation, not speculation. Investing is not speculation, it is preparation. Owning a tangible asset like a kilo of silver today is not a reckless bet. It is a principled stance rooted in an understanding of the long-term debt cycle, monetary manipulation, and structural industrial necessity. It is a strategic decision to allocate capital to an asset that benefits from the two most powerful and often opposing forces in the current economy: monetary disruption and technological advancement. If history teaches us anything, it is that imbalances are always corrected, often with brutal force. I encourage you to think seriously about real, non-debt assets. They are the most effective way to preserve wealth in a world where the purchasing power of paper money is actively being sacrificed to service an insurmountable mountain of debt. Thank you.